Hello, everyone, and good afternoon. On behalf of BizLaunch and Arlington Economic Development, my colleagues and comrades in arms, Alex Held and Lourdes Morales, we welcome you to our very second session of BizRefresh. And we're really excited today because we're going to be bringing to you one of our favorite economists that we have that's here in the region, Anirban Basu, and so excited to have him today from Sage Policy Group. We actually had him come speak to us, oh my gosh, I want to say a little over 10 years ago, which is so crazy. But when we were going through the Great Recession, he came and helped give some really great words of wisdom to our business owners as we face the recession and some of the issues and challenges that were unique to that time. And so we're really pleased that we can bring him back in somewhat another unprecedented times, but to bring him back today to kind of talk about the economy, where we're at, what's going on, and the future, to help you plan with your business as we move forward and as we move throughout this current health pandemic. And so we're your hosts today. Just some of the information. If you have any questions at any time, if you can't hear anything, or if you have questions of the presentation, or you just want to let us know that you're enjoying the session, please feel free to raise it in the chat box. Both Lourdes and Alex will be monitoring the chat box as we go through. And we want to make sure that you leave out today with some information that you didn't have before you clicked on to join. We really want to make a difference. We want to be able to help businesses by bringing in some amazing specialists and experts in areas to help with business development during these times. So it is our honor to provide you with an 8-week cohort, with this being the second one on an economist viewpoint. And so it's my pleasure to introduce our presenter for today. Man near and dear from my own heart because he hails from Baltimore, which of course is where I'm from as well, Anirban Basu with Sage Policy Group. Studying contradictions, but also very learned when it comes to the economy and what's going on and how businesses should need to respond to it. He's been recognized as Maryland's 50 most influential people. And I can understand why, because of all the time and work that he's done at the University of Maryland School of Law, First Mariner Bank, Baltimore School for the Arts, the Baltimore City Public Schools, developers, hospitals. He's worked in economic development, which is near and dear to our heart, and working and educating others and making sure that they have key access to information that they need to succeed. Teaches at Johns Hopkins, has done work at the School of Law, and at Harvard University's John F. Kennedy School of Government. So we're really, really pleased to have you here with us this afternoon, and looking forward to a very dynamic discussion. And we'll be back on the back end to answer any and all of your questions. So thank you all so much for joining us today.
And thank you for that kind introduction. My name is Anirban Basu. I am an economist. Please hold any further applause. And I've been asked to talk to you about the economy and where we are in the cycle and during this period of economic stress and what this means for Arlington County and the rest of the country. Yeah. I've entitled the presentation Return of the Economist. It is a Lord of the Rings themed presentation. This is your COVID-19 economic update. Now, there are many ways to begin such an affair. We could recite the Pledge of Allegiance, we could engage in prayer, we could sing the national anthem, maybe an honor guard, but I want to start with that old-fashioned standby, the ring verse, which goes 3 rings for the Elven kings under the sky, 7 for the dwarf lords in their halls of stone, 9 for mortal men doomed to die, 1 for the dark lord on his dark throne in the land of Mordor where the shadows lie, 1 ring to rule them all, 1 ring to find them, 1 ring to bring them all, and in the dark find them, You will see this organizational framework throughout this webinar. And by the way, I'm going to leave plenty of time for questions and answers. So please do think about what questions you'd like me to try to answer as we get toward the end of this session. As I say, you'll see this organizational framework throughout the webinar: 9, 7, 3, 1, 9 rings for the kingdom of men and women, 7 for the dwarves, 3 for the elves, 1 for the Dark Lord. You may not agree with anything I will say in my next hour plus with you, but one thing upon which we could agree, I think that Dark Lord has been pretty busy in 2020. What has the Dark Lord done? Well, the Dark Lord has given us COVID-19. This is a map of global cumulative confirmed cases of COVID-19 as of September 14th, 3 days ago. And one of the keys, for organizational leaders out there, and you're all that, one of the keys is trying to determine what to believe informationally and what not to believe. And that is more difficult than it sounds. I will give you an example. So one of the things I had heard coming into this period of pandemic, is that the virus doesn't like warm temperatures. And you might remember that the original epicenters of infection in America were largely in the American North. Obviously, Seattle, Washington, New York City, Cook County, Illinois, Detroit, Michigan. Oh, yes, Prince George's County, Maryland, Montgomery County, Maryland, so on and so forth. But a lot of the epicenters were in the North. And the notion was, we're going to close down the economy, we're going to flatten the curve of infection, but watch out for November, December, and January as cool temperatures reemerge and we start to see an acceleration in viral infection. No one told me that I should be worried about Florida in June, July, and August, or Arizona, or Texas, or Southern California. But what this map stands for is the proposition that whether a nation is close to the equator or far from the equator, whether it's Siberia or the Sudan, the infection has found its way into every place where human beings live. And in fact, if you look at the epicenters globally of infections right now, they include places like India, Brazil, Mexico, but also Florida, Texas, Arizona, Georgia, so on and so forth. Now, there are some things upon which we could reasonably rely. So one of the things we thought we could do is flatten the curve by shutting down the economy. And indeed, if you look at US COVID-19 daily cases, to a certain extent, that's what's happened. And to a certain extent, that's not what's happened. So we start to shut down the economy in March. And I would argue to you that the crisis economically began on March 9th. And you might say to me, Anibal, that's very specific, but also incorrect. They call this COVID-19 for a reason, sir, and it's because it was discovered in 2019, whether in November or December. So to suggest that the crisis began on March 9th seems ridiculous. Here's why I say March 9th. Until that day, the US financial markets hardly noticed that there was this emerging pandemic. Oh, sure, the week of March 2nd was somewhat volatile for financial markets. But it wasn't until March 9th that the Dow Jones and other financial indicators started to really respond. On March 9th, the Dow Jones declines more than 2,000 points. That, at that time, was a daily point decline record for the Dow Jones. It was not until March 11th that the Utah Jazz are ushered away from the basketball court as it's determined that their all-star center, Rudy Gobert, is COVID-19 positive. A few days later, his fellow all-star guard forward Donovan Mitchell is also thusly diagnosed. That's around that time that the NBA postpones its season. Wasn't it? We also received other indications. For instance, the Dow Jones set new daily point decline records on March 12th and March 16th as we start to shut down the economy. Now you can see, if you look at the red line, that 7-day average of COVID-19 cases, that the 7-day average is falling through April into May into early June. But then we start to see a spike in infections, particularly in Florida, Georgia, Texas, Arizona. Some of that is a reflection of public policy. The first state to reopen their economy was Georgia's under the leadership of Governor Brian Kemp. He opens up that economy circa April 20th, followed shortly by Governor Ron DeSantis of Florida just a few days after that. And so infections take off. Where? In the American South. Well, that wasn't supposed to happen based on what I had heard, at least, many of you may have heard early in the crisis. Now, you can see that once again, we have begun to flatten the curve, but we're still looking forward to November, December, and January. So the pandemic is still with us, and that shapes the economic outcomes to come. Now, one thing upon which we could rely was certain types of economic analysis early in the crisis. This slide is based on a report that came from the Federal Reserve Bank of St. Louis as of March 24th, so pretty early days in the crisis, March 24th. And basically they asked the question, who's at risk of losing their jobs? So their study encompassed 144.7 million jobs. If you look at the first bolded row there, employed in occupations at low risk of layoff, 54%, low risk of layoff. Who are these folks? They're employed in essential occupations like healthcare and construction, or they're employed in occupations where it's possible to work from home. Economists have estimated that about 37% of us can do our jobs completely from home, 37% of us. Now, if you look at the second bolded row here, employed in occupations at high risk of layoff, 46% or 67 million. Who are these folks? People in food preparation, that's your restaurant worker. People in sales, that's your retail worker. And so one of the things that's happened is that people who were already vulnerable economically because they were relatively low-wage workers, they worked in hotels, restaurants, and retail, have been hit hardest by the downturn, the most likely to lose their jobs. A lot of us who are white-collar professionals have the good fortune of being able to work remotely. And so our incomes have been often less impacted. Obviously, there's many stories out there. So we knew that there was this a massive amount of vulnerability. 46% of the occupations at high risk of layoff. And then what happens? Well, after March comes the second quarter. And what was the second quarter? The second quarter was the worst quarter of our economic lives. This is quarterly gross domestic product. Now, the economy, as it turns out, was, for the most part, still showing signs of some strength in January and February. Indeed, in January, we had more than 200,000 jobs. In February, we had 251,000 jobs, though there was some initial weakness in February, which I'll talk about later on in the webinar. So we shut down the economy last 3 weeks of March, roughly. In Maryland, basically our quarantine began for Maryland on March 13th. So the last 3 weeks of March are awful for the economy, and during the first quarter, because of those last 3 weeks of March, the economy shrinks 5% on an annualized basis. Now, I want to be clear about this slide. All the data, the gross domestic product data through 2019 are indexed in blue and are assigned to the left-hand axis, where it says 1990 to 2019. The first and second quarters of 2020 are indexed to the right. Those are the red bars. So as I say, in the first quarter, we shrink 5%, and then here comes the second quarter, the worst quarter of our economic lives. The economy shrinks 31.7% on an annualized basis. A couple of things to note about that. It was worse in some other places. In Great Britain, the economy shrinks 58.9% on an annualized basis during the second quarter. So there's that. But that is, a massive loss in economic output, obviously. So when you've got so much vulnerability, so much susceptibility to job loss, and then you get a quarter like this, what are you going to get? You're going to get a ton of dislocation. Now, one of the things I want to do for you is I want to set a statistical baseline. I want to talk about where we were prior to the crisis so that we can get a sense of what full or complete recovery would look like. And of course, the hope is that we get back to where we had been, because macroeconomically, we were in a really good place. And if you're going to talk about the pre-existing strength of the US economy, I think you've got to start with the US labor market. So this is monthly job growth in America. All the data through February of 2020 are represented in blue colored bars and indexed to the left-hand axis. On the right-hand axis, March, April, May, June, July, and August of 2020. And I'll explain in a moment why I bifurcated the axes. Now, as I say, we're adding jobs through February. Indeed, in February, we had 251,000 jobs. February represented the 113th consecutive month of job creation in America. It was an unrivaled winning streak. And over that 113-month period, America added 22 million net new jobs, driving the unemployment rate nationally down to 3.5%. That was a 50-year low. You'd have to go back to December of 1969 to find unemployment as low as it had been pre-crisis. And just to give you a sense of how long ago that was, the Orioles were good back then. That just gives you a sense of how long ago that was. But that ends in February. In March, we start to lose jobs if we shut down the economy. Again, indexed to the right-hand axis. In March, we lose 1.4 million jobs. It's a titanic total. But then in April, we lose 20.8 million jobs. And if you do the math on that, we lost 22 million jobs during that 2-month period, March and April, which eviscerated all the job creation we enjoyed during the previous 113 months. And economists were quite pessimistic by this point. Of course, a group of economists surveyed by the Wall Street Journal around that time, but most of the economists who work for U.S. banks, major U.S. banks, indicated they expected that in May, America would lose 8 million jobs. Nope, they were wrong. America adds 2.7 million jobs in May, and then follows it up with 4.8 million jobs in June, and then 1.8 million jobs added in July, and then nearly 1.4 million jobs added in August. Now, if you were to graph those numbers, say the 1.4 million jobs we had in August, and put that on the left-hand axis, it'd be a really tall bar. And I would argue to you, based on this data series and other data series I'll show you, that the initial stage of the recovery has been quite strong, and I would argue V-shaped, not U-shaped, not L-shaped, not check mark, not Nike swoosh, not square root, V-shaped. But we'll talk more about that as we go through the data. Now, please do not get me wrong. Even though the initial stages of expansion were quite strong, we still have a long way to go, of course, to complete recovery. If you compare August 2019 national employment to August of 2020, we're down 10.2 million jobs. Now, which sectors have lost the most jobs? Well, at the top, you can see the category called leisure and hospitality. That's your restaurant and hotel worker. That sector has lost more than 3.8 million jobs on a year-ago basis. Professional business services. Now you say, well, I'm surprised, Anirban. You know, your accountants, your attorneys are in that category, architects, they can work remotely in large measure. And so I'm surprised that that's the second leading sector in terms of job loss. Well, first of all, it's a very large sector. But second of all, it also includes temporary workers, people who work for temporary staffing agencies, and we've seen a lot of job loss in that category. The third category includes your retail worker, trade, transportation, utilities, it includes retail trade, but it also includes all the jobs being added by Amazon. Amazon also shows up in that category, but the jobs being added by Amazon and other e-commerce giants does not offset all the jobs lost in brick and mortar retail. But every sector of the economy has lost jobs over the past year, and the same is true in the Washington metropolitan area. The Washington metropolitan area, of course, came into this period with a smashingly good economy. And you can see this in terms of development potential. And one of the big deals, obviously, was that we had this once-in-a-generation economic development competition. It turns out to be for Amazon's HQ2, and Arlington County wins. Really quite remarkable, because there's 3,000 plus counties in America, and the one that wins is the one I'm speaking to. But mimicking the nation, where have we seen the most job loss? Now, this is for July 2019 versus July 2020, because the August data are not yet available at the regional level. But the sector that's lost the most jobs, not surprisingly, leisure and hospitality. Again, that includes your restaurant and your hotel worker. Health services, as it turns out, ironically, has lost a lot of jobs. Why is that? Because people postponed elective surgeries. They didn't do their wellness visits. They didn't go to the dentist, so on and so forth. So we saw actually a lot of layoffs in healthcare, even as segments of the healthcare infrastructure were overburdened by COVID-19 patients. In any case, every sector losing jobs. Construction losing relatively fewer jobs, because one of the things you note is that there's still a fair amount of construction in the environment, but also construction was deemed to be one of those essential industries. Now, this is employment growth between July 2019 and July of 2020 for the 25 largest metropolitan areas in America. So here you see an admixture of public policy, viral realities, the level of infection, and the structure of regional economies. So which governors have been least likely to shut down their economies completely and most likely to reopen their economies quickly? Well, governors largely in the American South. So where have we seen the least job loss in percentage terms over the past year? Phoenix, Mesa, Scottsdale, Arizona. But also towns like Dallas, Tampa, San Antonio, Atlanta. Where have we seen the most job loss? New York, which of course was a viral epicenter, but also where the governor there, Andrew Cuomo, was very aggressive in shutting down his economy. I'm not arguing that that was good or bad. I'm just saying that that had economic implications. Massachusetts, lots of job loss because they've been aggressive in shutting down their economy. Indeed, in much of Massachusetts, even construction was not deemed to be an essential industry. Indeed, statewide, Massachusetts at 16.1% has the highest unemployment rate in the country, which is incredible because it may also be the most educated state in the country. The two things often don't go hand in hand. Detroit Metro was a major viral epicenter, southeastern Michigan. And then California, that governor, who happens to be very handsome, also has been very aggressive in keeping that economy shut down. So you see San Francisco, Los Angeles, San Diego, and Riverside with lots of job loss over this period. Again, a reflection largely of public policy. Then comes Orlando. You say, Orlando, Anibal, that's in Florida. Governor Ron DeSantis there, he's been quite aggressive in keeping that economy open. You're right, but Orlando is largely about leisure and hospitality and retail trade, segments that have been hit harder. So economic structure plays a role here as well. Now, of course, with all of this job loss comes higher unemployment. Let's talk about that. Here I'm showing you three rates of unemployment. Total unemployment in red, in blue, male unemployment in green, female unemployment. Now, during the previous economic downturn, men suffered relatively more. And that's because male-dominated industries like construction and manufacturing really took it on the chin. You'll remember that what caused the Great Recession, at least initially, was a downturn in the housing market, the housing bust. And of course, that ultimately translated into a lot of construction jobs being lost. This time has been different. This time, women have suffered relatively more. Why is that? Because they're more likely to be wedded to industries like leisure and hospitality, retail, daycare centers, private schools, public schools, and an easy majority of American nurses are women. So they have been disproportionately on the front lines of delivering care to the ill, and sometimes they themselves have become ill and therefore at least temporarily separated from their employment. But here's the good news. In April, the unemployment rate nationally is 14.7%. But by the way, don't you believe it? It was actually much higher than that. There were some statistical glitches in the underlying survey that generates the unemployment rate estimates. And most economists agree that the unemployment rate was understated by around 3 to 5 percentage points around April timeframe. And also the so-called reference week, the time during which the survey was taken was quite early in April. So it didn't capture all the damage being done to the economy in April itself. And I'm quite confident that by late April, unemployment in this country is around 20%, though I can never prove that to you. In any case, by August, unemployment is down to 8.4%. Again, an indicator that the initial phase of recovery has been quite profound because many economists had predicted that we would end this year with more than 10% unemployment. We're already down as of August to 8.4%. This is unemployment rates for those same 25 largest metropolitan areas. Who has the lowest rate of unemployment? Baltimore. How can this be? Structure of the economy. So Baltimore is home to many government agencies, including the Center for Medicare and Medicaid Services and Social Security Administration. It has a lot of defense contractors, also has a large financial services sector, also a big medical research sector. So a lot of people who can work remotely or whose jobs are just not that at risk. Washington Metro, you say 7.9%, and it's quite rare for the Washington metropolitan area to have a higher unemployment rate than Baltimore. So why is this happening? Because the Washington metropolitan area has a very large leisure and hospitality sector, and part of that sector depends upon global travel. But if you look at the spending of people traveling from abroad to America, that spending is down 97% on a year-ago basis. Basically, there is almost no international leisure travel happening right now. Spending by Americans abroad is down 94%. So in any case, because of that, lots of job loss in leisure and hospitality, and this result prevails. Where do we see the highest rate of unemployment? Los Angeles. Again, public policy plays a part. New York, Boston, so on and so forth. We've talked through some of these issues. Arlington County, Virginia unemployment rate. You can see how fabulous things were coming into 2020. This is monthly data through July of 2020. And then the sharp uptick in unemployment, such that the peak during this cycle was over 7%. But recently, the unemployment rate has fallen back down to 5.0%, still very high by Arlington County standards, but things are improving. And the question, of course, that we want to address is, okay, things have improved. Will they continue to improve? Because you'd want to build sort of notions of how the economy performs into your 2021 fiscal or calendar year budget. So we'll talk more about that as we go through the webinar. Now, you might remember a principal complaint of businesses coming into this pandemic. So before things got tough economically, a principal complaint was, hey, where are all the workers I'd like to hire? So construction firm operators would say, I can't find electricians, I can't find plumbers, I cannot find heating and air conditioning professionals, I can't find roofers, I can't find glaziers, I can't find superintendents, and I sure as heck can't find estimators. Manufacturers would say, I can't find machinists, and I can't find welders, where are they? And trucking firm operators would say, I can't find drivers, everyone knows I can't find drivers, I also can't find mechanics, which is actually kind of scary. So we had more job openings than unemployed people in this country pre-crisis. So there was enormous demand for human capital, and that was a beautiful thing. Humans were in high demand. And so when humans are in high demand, what happens? Wages and salaries rise. This is growth in wages and salaries, year-over-year percentage change in wages and salaries as measured by the US Employment Cost Index. So what have we said so far? Pre-crisis, of course, more Americans working, but also more people making money on the job. Amazon is not a 501c3. They're not a charitable organization. They're for-profit, 24/7. So when they raised their minimum wage to $15 an hour, it was not for charitable purposes. That was for recruitment and retention purposes, particularly at the fulfillment centers as they strive towards same-day delivery. Bank of America, not a charitable organization. Fine bank, but not a charitable organization. So when they raised their minimum wage to $20 an hour, not for charitable purposes, recruitment, retention, and a reflection of how strong the labor market had been. So more Americans working, more Americans making more money on the job. What do Americans do when they have some dollars in their pocket? You betcha. They go shopping. They put stuff in the baggage. This is US retail sales. Now, we received retail sales data for August yesterday. Didn't make a lot of headlines, but retail sales are pretty strong. But here's the thing. It should have made headlines. Why? Here's why. So in April, some people got that $1,200 check, part of the CARES Act. Some people didn't get that $1,200 check, but in any case, a lot of people did. And then people who were unemployed and eligible for unemployment insurance benefits, many of them were receiving $600 in supplements from the federal government per week on top of their routine state government benefits. So we had a fair amount of stimulus working its way through the economy. So the retail sales series starts to slump in February. And indeed, the National Bureau of Economic Research indicates that the recession began in February. That was pre-crisis in some sense, but by that time, our behavior had begun to change. We had heard about COVID-19, and some of us had begun to social distance. So you might remember when you went to meetings, conferences in February, you were no longer shaking hands, you were fist pumping, and then you did the elbow bump, and then you did the kid and play toe tap, if you know what I'm talking about, which I think you do. So February. Then March and April, retail sales fall off the table. Now, as we start to get that stimulus I'm talking about, retail sales surge in June. Why? Because the economy is reopening and some people have extra cash on hand because they got that $400 check, because they were receiving $600 in weekly federal supplements to their state unemployment insurance. Okay, and then July sales are even stronger. But what happens after July? The $600 supplement to unemployment insurance, that goes away. And most people have probably spent that $1,200 that they received in April. So now the economy is not really operating on stimulus anymore. So some people thought, oh, in August, retail sales are going to slump. No, you can see here, August retail sales are pretty good. And moreover, if you look at these last few skinny bars here through August, you might be able to carve out the letter V. V for victory, because the initial stage of recovery has been quite profound. I'm going to show you even more data suggesting the strength or indicating the strength of this initial phase of recovery. This is US restaurant reservations. So one of the things that we've been doing as economists, and others have been doing this too, is looking at high frequency data because things are changing all the time. We don't necessarily want to wait for monthly data or quarterly data. So this is year-over-year percentage change in restaurant reservations, and these data come from Open Table. Now, you can see in March and April, we go to negative 100%. We shut down the economy. No seated diners. It's really quite remarkable if you think about it. Now, we start a recovery that's quite dramatic in May into June, and then what happens? Things flatten out again. Why? Florida, Texas, Arizona, Georgia, Southern California, the virus reemerges, and some of these reopenings are reversed. More recently, and the data are quite volatile lately because of Labor Day and the effect of that on restaurant reservations, but more recently I see again an upward trend. So that the high frequency data continue to indicate, and I'll show you more high frequency data later in the presentation, that the recovery is an ongoing one. We are still coming back during this period of economic stress. Here is the miracle of the expansion as it has been. This is the miracle right here. So this is inflation, a measure of inflation. This is the core CPI, or core consumer price index, a proper measure of inflation. It's the annual rate of change in inflation. So, or annual rate of inflation. So, so one of the things I've been taught in school was that when unemployment goes down, inflation goes up. It's the Phillips curve. And when I was tested on that in college, it was not an essay question. The professor did not ask me, Anirban, what emotions are you feeling? Tell me about your feelings when you hear that when unemployment goes down, inflation goes up. No, it was a true-false question. It was true or false. When unemployment goes down, inflation goes up. True, professor, done. So if I tell you that unemployment goes to a 50-year low, and I remind you that during the Great Recession, the previous period of economic stress, that the Federal Reserve increased its balance sheet from $800 billion to $4.5 trillion in an effort to increase money supply. You might say to me, Anirban, based on a 50-year low in unemployment and all that new money supply, we're going to have an inflation problem in America, but we didn't. This graph stands for the proposition that inflation has been running at between 1.5% and 2.5% in America pre-crisis, per year. That's perfect. The Federal Reserve's target for inflation is 2%. In fact, the Federal Reserve has been so unconcerned about inflation that last year they cut interest rates not once, not twice, but thrice, even as we marched toward that 50-year low in unemployment. That was a so-called mid-cycle adjustment, turned out to be a late-cycle adjustment. Now, you can see during the crisis itself, for the most part, we've had disinflationary pressures. Inflation has fallen. But if you look at the last couple of readings here through August, we're starting to see some inflation bounce back. And that may be a concern to you at some point in the next year or 2 years, that we might be talking about an inflation problem in America in 1 to 2 years. It's conceivable, given federal deficit spending and money supply creation and the just general bounce back of economic activity. But that's not the story right now. The story right now is that inflation is pretty low and interest rates are pretty low. This is the yield on the 10-year Treasury. One of the things that we've seen, of course, is extraordinarily low mortgage rates. So if you've spoken to a realtor, or let's say you spoke to a realtor pre-crisis, they might have said something to you like this. Look, I've got all kinds of people looking for homes. I got baby boomers looking to downsize. I have millennials looking to form households, maybe even move to the suburbs. Here's my problem as a realtor. I got nothing to show them. Inventory is so low, especially in the best neighborhoods with the best school districts. So, it doesn't surprise you, shouldn't surprise you that pre-crisis, home prices were rising in America. This is the S&P Case-Shiller U.S. National Home Price Index. And what it shows is that home prices have been rising for quite some time. That shouldn't surprise you. Mortgage rates are low and the economy has been growing. Fine. What might be surprising, at least from the perspective of what we've been through, is that home prices have been rising throughout the crisis. Because there have been some behavioral shifts that have been caused by the crisis. So, and we'll talk more about behavioral shifts as we go through this material, but here's one factor to think about, demographics. The most common age in America this year is 28. We have more 28-year-olds than any other age. The second most common age in America is 29. The third most common age in America is 27. We've got a lot of 20-somethings in our society. Makes that difficult as they tend to be obnoxious. but they are now entering their 30s in larger numbers. 5 years ago, the most common age was 23. And when people are 23, what do? They rent apartments. No surprise, what have we seen? An apartment building boom in the Washington metropolitan area and throughout the country. But in a few years, the most common age in America will be 33. And that's when often these days people form households and often think about moving to the suburbs. Of course, what has happened with the pandemic? More people wanted social distance. Interest rates have fallen further, so more people want to take advantage of that by owning a property. And of course, there's this other factor of people needing home offices in their residences. They need an extra bedroom to turn into that home office. And where are those homes? Well, they're in the suburbs. So we are starting to see this migration back to the suburbs. The previous decade was very much about the cities, including the District of Columbia. It's about people pouring into highly dense communities. This next decade will be more about suburban economic growth. And you can see that. You can see Manhattan and San Francisco rents falling, even as home prices surge in Connecticut's New York suburbs and in places like Westchester County outside of New York. And I think you're going to continue to see that, and COVID-19 has advanced what would have probably already would have transpired anyway because of demographics, but becomes even more of a strong compulsion given COVID-19. Now, so what do we have here? We've got a lot of people looking for homes. We've got a low active inventory. So guess what? With a lack of inventory and people looking for homes, that creates the opportunity for more construction. This is US residential building permits. It's a leading indicator of residential construction. You have to pull a permit before you construct something. Now you might notice if you look at these data, there was this surge in residential building permits late last year, pre-crisis. Again, because we have these dynamics in place in which low mortgage rates, healthy economy, more people looking to move into a home that they own. Now, during the crisis itself, you can see that permits fall. Well, of course. And in some cases, it was difficult to pull a permit because the government office that issues permits itself was closed for business. But what have you seen more recently? Permits have spiked back up again. In fact, in August, home builder confidence in our country reached an all-time high. And again, if you look at the data carefully, those last few bars there, you can sort of carve out the letter V. Again, V for victory, or at least a vigorous economic recovery to date. And then finally, to establish that pre-existing statistical baseline, let me talk about the stock market. So one of the indicators of economic strength, but also a source of economic strength and wealth, was the booming stock market. Here I've indexed the Dow Jones to the right, the NASDAQ, and the S&P to the left. Now, I think one of the most remarkable aspects of economic life, and I think you'd agree with this, is how radically the financial markets have bounced back in America. I know the NASDAQ is way down today, but it's still around 10,800. It has been setting records recently, as has the S&P 500. And the Dow Jones has spent much of the day around 28,000. Actually, it's down right now 300 points, 294 points, 0.47, 28,000 is no longer the level of the Dow Jones. It's at 27,800. In any case, the point is, the markets, generally speaking, have performed well, given how badly the economy has performed. Now, I'll talk more about this in a moment, but I titled this slide, But It Goes to Elven, to pay homage to the fact that Lord of the Rings has lots of elves, but also to fully understand the title of this slide, you'd have to harken back to a movie that came out in 1984 called This Is Spinal Tap. And if you understand the reference, this becomes hilarious. But if you don't, that's fine. The point is, stock market was very strong pre-crisis, and it has bounced back tremendously during the crisis. And actually, you can see the letter V there on several occasions on this slide. Now, because of this pre-existing economic momentum, there are some economists who naively believed that we could get through this public health crisis without a recession. If you go back to newspaper articles back in February and into early March, you'd see a lot of economists suggesting we might be able to get through this without a recession. Nonsense. For two big reasons. Number one, even though the macroeconomic data looks very strong, there were some vulnerabilities that had built up in the US economy. And I'm going to talk about those now. So for instance, here's a vulnerability. Not all sectors of the economy were performing well coming into the pandemic. I'll give you an example, agriculture. The American farmer has been struggling. A lot of them have had to take on lots of debt, wrestling with the impact of trade wars, low soybean prices, low corn prices, monopolistic buyers. Here's another industry that was struggling coming into the pandemic, manufacturing. So you see the 50-yard line running west-east across that slide? This is the Institute of Supply Management's Purchasing Managers Index. Any reading below 50 means that manufacturing is in recession. And manufacturing, as it turns out, was in recession for 5 months late last year. Why? Trade war. Weakening US auto sector, which really peaked in 2016. Strong US dollar, which among other things frustrates US export growth and invites in more imports. And then Boeing and the issues with the 737 MAX. But lo and behold, what happens late last year? We sign a first phase trade deal with China. We get ratification of the USMCA, the US-Mexico-Canada trade agreement, and we get Boris Johnson's resounding victory in the United Kingdom, which gave us more certitude regarding Brexit. When was the last time you talked about Brexit? You might have talked about Boris Johnson in this pandemic, but maybe not so much Brexit, at least until very recently, perhaps. So some of the uncertainty revolving around the US manufacturing sector abated, and by January, this reading is back up above 50. Manufacturing is out of recession, the reading 50.9. But then, as we get supply chain disruptions coming out of China and elsewhere, as the global economy starts to shrink, manufacturing tumbles back down into a deep recession. And then lo and behold, what do you see here? A sharp bounce back in manufacturing activity as inventories need to be rebuilt, whether at auto dealerships or elsewhere. You see the letter V. But the point of this slide is not that. The point of this slide is to point out that there was some pre-existing vulnerability in that not all industries were participating equally in the economic expansion that preceded the pandemic. But by far, I would say the leading source of vulnerability is indebtedness. So the federal government came into this with a $23.5 trillion national debt into the pandemic period. The national debt is now closer to $27 trillion. These data come from the Nonpartisan Congressional Budget Office. The light blue colored bars represent projections from March of 2020. So these are pre-COVID-19 projections. And even though the economy had been performing, the projection as of March was that we would run a $1.1 trillion federal budget deficit in fiscal year 2020 and another $1.0 trillion in 2021. In September, these projections were revised. It is now believed that for fiscal year 2020, the federal budget deficit will be $3.3 trillion. Well, that's equivalent to 16% of gross domestic product. And next year, absent further stimulus, $1.8 trillion. But again, there was this pre-existing vulnerability in that we'd amassed so much national debt. And one of the sources of awkwardness in Washington right now on Capitol Hill is people are having a difficult time trying to figure out, can we afford another stimulus package when we've amassed so much debt? And it's a reasonable question to ask, as it turns out. But that's not where the indebtedness story ends. The US household has never been so indebted on average. Here I'm showing you various flavors of household debt. Mortgage is in orange. That's by far the leading source of debt, followed by student loans in red, credit cards in blue, and auto loans in green. But coming into this crisis, American households had accumulated a lot of debt. Well, of course they did. Why does the Federal Reserve keep interest rates low? It's to get people to borrow and spend, borrow and invest. So with interest rates so low for such a long time, of course we took on more debt. That's what policymakers wanted us to do. And of course, while we're taking on debt and then spending money or investing money, that helps support the economy, but we also have more leveraged balance sheets. And speaking of leveraged balance sheets, we certainly have a lot of those in corporate America. US corporate debt has never been greater. You say, Arlington, how is that possible? You just showed a slide showing a booming stock market. And I've heard that corporate earnings have been very strong. And is it true, is it not true, that we cut corporate taxes in late 2017? True, true, true. So haven't companies had a lot of cash on hand? Yes, they have. So haven't they had the wherewithal to pay down their debt? At least in part, yes, they have. Then why are you showing the debt is accumulated? Because it has. Because, look, let's say that somebody drops $40,000 into your lap right now, $40,000. You could take that money and pay down some of your debt, or you could use it as a down payment on your C8 Corvette, which is, by the way, what I would recommend. So when companies have lots of cash flow, they can actually turn that into more leverage to, for instance, buy back shares. And you understand the game. If you buy back shares, shares outstanding declines, earnings per share therefore go up, And when earnings per share go up, that tends to drive up the share price higher. But you're also left with a more leveraged balance sheet. And also when you buy a leading competitor or the latest technology company with the latest platform, that would also tend to drive up debt to the extent that those deals are financed with debt. And so this is another source of awkwardness. You know, early in the crisis, there was some awkwardness at Boeing. Boeing raised his hand and said, you know, I know the crisis is only a few days old, but we're going to need $60 billion. $60 billion. We only have one competitor in the world, and they're in Europe, but we're still going to need $60 billion. That was a reflection, of course, of the MAX 737 and the impact of COVID-19, but also the pre-existing vulnerability of that company because they had amassed so much debt. Now, there's some other structural issues at work here. I'll give you an example: productivity. So macroeconomically, economic growth from a long-term perspective is simply productivity growth, and productivity is typically measured as output per hour worked plus labor force growth. That's it. How quickly is your labor force becoming more productive plus how much is it growing? And that's economic growth. When I was growing up, I grew up in Kankakee County, Illinois, on the Indiana border, and yes, every bit as exciting as it sounds. I was told, Anibon, because that's my name, Anibon, America grows 3% a year in real terms. 3%. That's who we are. We're a 3% people. Sometimes faster, sometimes slower, sometimes Jimmy Carter's president, sometimes Ronald Reagan, sometimes Bill Clinton, but 3% on average. You ask economists like myself how fast we'll grow in the long term, setting aside COVID-19, I'll say less than 2% is our destiny. Why? Well, look at the third bullet here. US productivity has risen at an average rate of 1.6% since 2007, compared with the 2.2% average since the end of World War II. So right there, you're taking off 60 basis points, 0.6 of a percentage point off of potential growth. But also, the labor force is not growing the way it once did. We haven't had as many babies in previous decades. Indeed, at 1.73, the American female fertility rate is the lowest on record. Immigration policy has shifted. We've got lots of baby boomers retiring, and that is a freakishly productive generation. The average electrician in our country is almost 60 years old, 60, and they are productive. But they're dropping out the labor force now. They're headed toward retirement. So given the lack of productivity growth and the lack of labor force growth, I would say less than 2% is our potential economic growth. There's more. So right now we're fixated on COVID-19, and well, we should be. But let's not forget that there are other issues coming from other parts of the world. This is the Global Economic Policy Uncertainty Index. And yes, we're fixated on COVID-19, but that doesn't mean that there isn't a North Korea. It doesn't mean that there isn't a Russia or an Iran or a France, and those people can be very rude. So I graphed this back to 1998, but not arbitrarily. Do you remember 1998? I think most of you remember 1998. The next year you partied like it was 1999 because it was, and Prince told you to. But 1998, remember what the big issue was in 1998? Are you blushing? Are you a little embarrassed? Are you afraid to say the words? Don't worry, I'll say them for you. What was the big issue in 1998? Monica Lewinsky. But she was hardly a threat to the geopolitical structure. But then what happened? 9/11 occurs in 2001. Then we have two major wars involving the Americans. Global financial crisis, 2008, 2009. Sovereign debt crisis in Europe, 2011, 2012. Then trade wars and more trade wars and COVID-19. And it's a pretty dangerous world, as you can see from this index. There's lots of risk coming to us from various parts of the world, and one of them is the buckling global supply chain. And the fact that the confluence of interests across nations is not what it used to be. Global trade regimes have begun to fall apart, whether because of Brexit or US trade policy or whatever. And again, I'm not arguing that's good policy or bad policy. I'm just saying that it creates a bit more uncertainty from sources that have not created that kind of uncertainty. And then finally, I would argue to you that the stock market coming into this period was elevated. Stock prices were elevated. Here I'm showing you the Shiller price earnings ratio back to 1980. So what I'm trying to do for you is I'm trying to juxtapose the price of shares on the S&P 500 vis-a-vis their underlying corporate earnings. And all I'm trying to say here is that coming into the crisis, share prices were high relative to earnings. Not as high as, let's say, March of 2000, just before the dot-com bust, but high. Now, you see the V there at the end there? That's that downdraft in stock prices, and then again, stock prices have become, I think, pretty fully valued out. You may disagree. You might think the stock market is cheap. Fine, we can talk about that during Q&A. But the point is, that's a source of vulnerability, because what goes up can come down. What goes up a lot can come down a lot. Don't get me wrong. At least a meaningful fraction of the bull market of the previous decade was justified on economic grounds. Some very special things happened in the previous decade, the decade of the 20-teens. Number one, we did not have a recession in the 20-teens. We went the entire decade without an economic downturn, the first time that happened in American history. Moreover, America's share of global output rises during the previous decade. For decades, America's share of global output has been in decline, and some of that has been engineered. By whom? The Americans. It's the Americans who fashioned the Marshall Plan to help rebuild Europe post-World War II. It was the Americans who spent some of their own treasure to accelerate Japanese economic recovery post-World War II. The effort being to transform our sworn enemies into our future trading partners, and boy, did it work. Germany today is the fourth largest economy in the world. Japan is third. Italy is eighth. But as I say, something very special happened in the previous decade. Our share, America's share of global output, actually rose from 23% at decade's onset to 25% by decade's end. Look, I know, you know, America has a lot of issues. We've seen some of those issues play out on the streets of Rochester, Kenosha, Portland, Oregon, elsewhere, Minneapolis in recent weeks. We know we've got this massive national debt and crumbling infrastructure and fragmented politics. But on a daily basis, we must be doing something right, particularly American business people, because, and their workers, because we are home to less than 5% of the world's population, but a quarter of its output. But does this performance, as remarkable as it is, justify this performance? This is stock market returns by country 2010 to 2019. Now, again, you may not agree with anything I've said thus far or anything I'll say in our remaining time together. But upon one thing we can agree, a decade has 10 years. So you take that red bar, that's the United States there, 256%, and you divide that by 10, you get a back of the envelope computation with respect to the annual rate of return on stock market investments in America. And it's not off the chart, because it's literally on the chart, but you get my point. Compare that to India, a nation that pre-COVID-19, during a very bad economic year, would grow around 6% in real terms, but you wouldn't know from a stock market performance. Emerging markets generally grow faster than America in economic terms, but again, you wouldn't know that from stock market returns. So what I showed you in absolute terms, price earnings ratio, or relative terms like I'm showing you here, America entered this period with vulnerability, really high share prices, and I still think they're quite high, and they're actually giving back some today. The NASDAQ is down 213 points as I speak to you right now. But the biggest reason for why it was impossible for us to get through this crisis without a recession is that COVID-19 is just different economically. And to try to simplify their understanding of the crisis, many economists have tried to compare this to other moments, other periods of economic stress in America. So from a stock market perspective, many people have compared this to October of 1987. I've heard comparisons between the current episode and 9/11. Some people have compared this to Hurricane Katrina's effects on New Orleans in 2005. And of course, many comparisons have been made with 2008, 2009. Hogwash, all of it. I'll give you an example. 2008, 2009, that was a demand shock. What happened? The money disappeared. From where? Everywhere. Value of people's portfolios, value of people's homes, bank balance sheets. The air came out of the balloon. So what did we do? We put air back in the balloon. We passed the Troubled Assets Relief Program to recapitalize the banks. We blew up the Federal Reserve's balance sheet from $800 billion to $4.5 trillion. The Federal Reserve's balance sheet right now is around $7 trillion, by the way. But we did that to add money supply to the economy, liquidity, and I would argue it worked, because that produced the longest economic expansion in American history without producing inflation. But this is not a demand shock. This is a supply shock of a caliber unknown in modern times. This is quarantines, travel bans and restrictions, closure of public places. I don't care. You shouldn't care. What kind of momentum we had coming into this pandemic? You shut down the economy, you're in recession. Now, I'd argue to you the recession ended in May because we added 2.7 million jobs that month. That's not the economy receding anymore. But of course, all that public policy leads to factory closures and supply chain disruptions. True enough, when you lose 20.8 million jobs in April, that triggers a follow-on demand shock because so many people are losing their jobs, they're losing confidence, in many cases, they're losing income. I say many cases because in some cases, some people actually made more money by being on unemployment than they were on the job. Let's set that aside. Now again, things can change very quickly, so we continue to focus on high-frequency data. Here's some data that came to us this morning at 8:30 Eastern Standard Time. This is initial claims for unemployment insurance. And because it comes out every week, it's been getting a lot of attention during the crisis because, again, people don't want to wait for monthly data or quarterly data. So we got some good news here, ladies and gentlemen. During the week ending September 12th, the advanced figure for seasonally adjusted initial claims was 860,000, and that was a decrease of 33,000 from the previous week. So if you look at this line, the blue segment here is the pre-crisis level of unemployment insurance claims, which was around 210,000 per week. So about 210,000 people per week before the crisis were filing for unemployment insurance. During the week ending March 28th, that figure rises to 6.9 million, and then the week after that, 6.5 million. But again, if you look at the red segment, which overlaps with the crisis period, a nice decline in the number of initial week claims. Now, some of you might say, look, Aniband, before the crisis, we're running at 210,000 initial unemployment claims. The latest figure was 860,000. In what way is that good news? Fair point. You may be a glass half empty person. If you're a glass half empty person, you look at this and say, this is awful. If you're a glass half full person, you say, we're making progress. And also, this is not the whole story, because this is akin to listening to one side of the conversation. Because what the initial unemployment claims data show us or reflect is there are people losing jobs. But what we might be interested in is not just that, but also who's securing new employment. And for that, we might look at continuing claims, the number of people actually on unemployment insurance. Now, we received data on this morning as well. During the week ending September 5th, the advanced figure for seasonally adjusted insured unemployment was 12.6 million, a decrease of 916,000 from the previous week. That's a big number. Now, again, you can look at this and say glass half empty. We've got so many more people on unemployment insurance than we did pre-crisis. And there's another group on what's called the sort of pandemic emergency unemployment insurance. There's another big group there. So that's a fair point. I'm not suggesting to you that we've completely recovered. All I'm suggesting here is that the initial phase of recovery has been quite robust, and the evidence suggests from the high frequency data that recovery continues despite the fact that there's less stimulus working its way through the economy right now. And I have been saying for quite some time that the initial phase of recovery would be quite strong, not U-shaped, not L-shaped, but V-shaped. And I base that in part on the resiliency of advanced economies from previous crises, including pandemics. These data come from Goldman Sachs, and I fully recognize that there's too many lines on this graph by half, so let me walk through this. To make this simpler, let me ask you to fixate on one line on this graph, the blue line that goes way up to the top and back down again. Just fixate on that one line. Hong Kong, SARS, 2003. Hong Kong, SARS, 2003. You see the black line at 0%, the skinny black line there? That is a stand-in for the pre-existing rate of economic growth. So as a pandemic smashes into a society, what happens? Growth falls below that pre-existing rate of economic growth. Well, of course it does. First, of course, it's tourism and transportation that's affected, but then increasingly it's construction, manufacturing, financial services, so on and so forth. So as you see from the blue line there, things get worse economically before they get better. Yes, of course they do. But then if you look at this, there's a sharp bounce back in economic activity. You see the letter V there. And advanced economies are extraordinarily resilient. America has proven that in the face of 9/11, the global financial crisis, so on and so forth, and during the early phases of recovery during this period of pandemic as well. Now, one of the reasons that there's such a robust recovery is that governments don't just stand still in the face of crisis, they act, including in the form of passing stimulus packages. We've had 4 rounds of stimulus thus far. The big one here is phase 3, the Coronavirus Aid, Relief, and Economic Security Act, or CARES Act. That was a $2.2 trillion package. That's your $1,200 check, those direct payments to Americans. That's the Paycheck Protection Program. We put more money into that program less than a month later, April 24th. So, recoveries tend to be quite dramatic from this period, and that's exactly what we've seen since May, a fairly robust recovery. Here's another thing. Let's say we don't get a stimulus package passed this month by Congress. Let's say they can't do it. They can't figure this out. Should it be $1 trillion, $1.5 trillion? What should be in it? Should we give assistance to New Jersey and Illinois and all that kind of stuff? There's some good news here, because even if we don't have stimulus, there's still some cash out there. And that takes me to the US savings rate. So this is savings as a percentage of personal disposable income. Now, prior to the crisis, the US savings rate is around 8%. 8%. Oh, look, some people are saving and some people are taking on debt, but the average savings rate is around 8%. Now, in April, some people got that $1,200 check. Some other people are getting those relatively generous unemployment insurance benefits. Indeed, it's estimated that about 68% of those who receive those federal supplements to unemployment insurance, that's $600 a week from the federal government on top of their state benefits, made more on unemployment than they did on the job. Okay. And the economy is shut down. So money's coming into the household, but the economy is shut down, right? Can't go to the mall, it's shut down, and there's only so much I can order on Grubhub. So by April, the savings rate is 33%. People have stockpiled cash. I know there's a narrative out there right now about people don't have money, they can't make the rent, and there are lots of people like that, don't get me wrong. But there are another group of Americans who have been stockpiling cash, right? Creating a rainy day fund. Now, as the economy reopens in May, June, July, the savings rate comes down because people are starting to spend more of that money. But even by July, the savings rate is 17.8%, still out of stockpiling of cash. And that cash is very important because it can continue to fuel retail sales even in the absence of further congressional stimulus. So what that tells me is that there's still some demand out there and the wherewithal to buy goods and services, at least coming out of the consumer sector. So that's quite positive. So that takes me to my final slide, the one forecast. So I had said months ago, starting in March, I haven't changed the first bullet here. The initial phase of recovery from this crisis will be sharp, profound, and most welcome. That's exactly what it has been. As people re-engaged the economy, they saw low interest rates. Their pent-up demand for goods was high, including homes, automobiles, and other things. Appliances. You know that there's a big backlog in appliances. If you've been trying to buy an appliance at Best Buy or wherever you try to buy appliances, you might have to wait 2 or 3 months to get what it is you want. So there's a need to rebuild inventories right now, which helps explain why manufacturers come back so rapidly. And we're human beings, and in particular Americans, so we're anxious to meet again. We want to go to restaurants. We want to go to casinos, some of us. We want to see a movie, maybe in a theater, not on Netflix, but an actual theater with too much popcorn, heavily buttered with too much salt, and a very large Coca-Cola and Twizzlers. It's the American way. We want to watch the Orioles, which is the most beautiful thing a human being can do short of nurturing a child. And want to engage in all the most wonderful of human activities. And we're seeing that, whether in beaches or college campuses. And some of that causes COVID-19 to spread. I get that. But people are engaging in this economy, and you see that in the numbers. May's jobs report was an absolute stunner. The economists predicting 8 million jobs lost. We had 2.7 million. One way to say it is that economists missed it by about 10.5 million jobs. Another way to look at it is that economists missed it by 2 weeks. That people were more ready to embrace the economy as it reopened than many people thought. June was even better, 4.8 million, and then July, August, decent, but softer. And yes, it is true that if you look at data regarding job openings and the pace of job creation in July and August versus June, that some of the data are softening just a bit. I see it with air travel, I see it with restaurant reservations, that the pace of recovery is slowing down. So while recovery has begun, these remain treacherous times. Obviously, that's true. We haven't yet earned a V-shaped recovery because we still have lots of viral infection in the air. And here comes November, December, January. And my fear is that we're going to have another supply shock as governments start to re-shut down the economy, which, by the way, is already happening in Europe because they've seen a spike in cases recently. So is it possible that we're not out of the woods yet and this V-shaped recovery could turn into a W? Yeah, it's possible, and it's dreadful. And that's why I'm hopeful that Congress will pass another stimulus package to get us to vaccine, a bridge to vaccine. But if Congress does not pass another stimulus, I'm quite worried about November, December, and January economically, because you can imagine what will happen to contagion at that point. Thankfully, we have more ICU beds, we have more ventilators, we have more testing, we have more ability to trace people, but it still might not be enough. And so I'll just leave it at that, and we'll take whatever questions we have in our remaining time together.
Wow. And Yvonne, that was a lot of amazing information. I'm still processing a lot of it. But one of the questions, and I know Alex is going to join us, and we're going to ask the audience to please bring the questions, because the information and how you presented it, and I love Lord of the Rings, just has me thinking. I can relate to the elves and, you know, the different processes, but I know that the stimulus itself has been on the table in the Senate and the House, and should this be something that as a community that we really should be pushing towards, because there are so many unknown factors? You know, I'm hearing more about, you know, Britain doing Brexit now, and pressure, and looking at the global economy, looking at some of the things that had impacted us prior to COVID that just seem compounded at this point.
Here's my answer to that question. It's a very good question. I think we've lost enough small businesses in America. I think we've lost enough jobs in America. I think we've created enough uncertainty in America. And now we have November, December, and January staring us in the face during the midst of a contentious presidential election. It's so much uncertainty that if this plays out, we're going to lose even more small businesses unnecessarily. Small businesses or medium-sized businesses or large businesses. Neiman Marcus, J.C. Penney, Brooks Brothers, they've all gone bankrupt during this crisis, right? So, my feeling is, look, we don't want to lose more entrepreneurial, desire. We don't want to lose more entrepreneurial spirit. And that's why it just makes sense to have a stimulus package. Now, what would that stimulus package contain? Because it matters how they craft the stimulus. Number one, assistance to state and local governments. And there's a lot of talk on Capitol Hill that suggests, well, we don't want to bail out New Jersey and Illinois. This is not about bailing out New Jersey and Illinois. You can see how revenues have been affected by the crisis, state by state by state. If you can backfill some of that for the states and large cities, for instance, or counties generally,
yes,
then I think you do a lot of good, because you don't want to see teachers, firefighters, police officers, garbage collectors, others lose their jobs unnecessarily. So that's one. Number two, more assistance to small business. And if you want to put a caveat on that assistance, say, if you create jobs, you can have some fraction of this forgiven in the form of a loan. Maybe not all of it. You can craft it the way you want. You're Congress. You're all powerful. So figure it out, but create an incentive for people to create jobs. And then the other thing about it is, what we did was, in some sense, and some business people might agree on this call, we created a disincentive for people to come back to work, right? Because if I'm making more on unemployment than I was on the job, I'm going to wait until those unemployment benefits run out, or at least that federal supplement. Now more people are starting probably to come into the job market, but you don't want to create another disincentive as we head into the winter and then eventually into 2021. So you got to structure that carefully. But some assistance to households during this period again could be an economic bridge to vaccine, because a lot of people are on the verge of eviction. So if people can make that rent payment, so on and so forth, you can prevent a lot of pain and dislocation. So they're playing with fire if they don't pass a stimulus. We just don't know. And I don't see how that makes sense, particularly when, yes, the federal government has a lot of debt. I get it, but interest rates are rock bottom. So if there was, I can't think of a better time to borrow money for the federal government than right now. So that's my answer to that question.
And also, I guess, looking at, you were saying that people are taking a lot of the money and saving it for different things. And I'm also seeing that people, are looking to shift houses around. I'm going to expand on my house. And so there are opportunities, and businesses may be holding on to some cash because of so many uncertainties or unknowns that are out there.
And cash preservation is part of the game here. mean, I say that to all the business people here. You know, I'm a small business owner myself, right? I'm
Mm-hmm.
thinking about cash preservation all the time because, look, I know that saying that cash preservation is a goal, an objective, a means to an end, doesn't seem
Yes.
like it makes a lot of sense because to the extent that companies are holding on to their cash, it would actually tend to slow the broader economic expansion. But I point out to people, you're no good to anyone as a business operator if you don't survive this. You're no good to your customers, your clients, your employees, or anybody else if you don't survive. So we've got to survive, and we don't know what November, December, January, February are going to look like. You know, I'm on the board of the University of Maryland Medical Center. We're already planning a big surge in cases from November through April, right, as a hospital system.
Yes.
So, and they're ramping up capacity to deal with this. That has to have economic implications. Again, it could be the case that Pfizer announces tomorrow, we got a vaccine, and by the way, overnight we produced 200 million vaccines. So come on by and we'll give you a vaccine. Okay, they're in phase 3. Moderna's in phase 3. And we've got over 200 clinical trials taking place. I think we're going to get a vaccine. We're getting close. The Indians are already buying a vaccine from the Russians. Very dangerous thing to do, to buy Russian drugs, but it's happening because they're desperate. So, and there's been, remdesivir, which is a Gilead Sciences drug, has been shown to have some clinical efficacy, so on and so forth. So we're in a better place than we were in February. Still, I'm worried. So that's why I talk about the stimulus, and then businesses have to respond by preserving their cash to carry them through the winter, because it's going to be a very uncertain winter.
And I guess this also leads me to a question in Arlington and then this DMV area. We're really beholden to global travel as well as hospitality. So to see some of those numbers from last year to this year, are there any thoughts for communities that are beholden in the hospitality sectors? What are some of the things that those businesses can do, or should communities be doing? Is it kind of pivoting and looking at where the opportunities are, doing things a little bit different?
Well, of course, you always want to look at doing things differently, right? That's almost always
Yeah.
true. But restaurant reservations are about 60% of where they were this time last year, 60%,
Yes.
and air travel is about 33%. But global air travel is nowhere. Here's what I would say. I really believe that once we get a vaccine, once we believe that we have herd immunity or just are broadly safe from COVID-19, you're going to see a remarkable bounce back in leisure and hospitality. There's so much pent-up demand. Any conversation you have with somebody, it's likely to focus on where we didn't go, where we wanted to go, what we were planning to do, but didn't get to do.
Our plans.
There are plans, right?
Yeah.
We were going to do this for our anniversary, this for our birthday. We're going to go to Tahoe. We're going to do this, right? We wanted to go to Japan, wherever it happened to be. So that pent-up demand is there. And so a hotel operator who can survive this, a convention center that can survive this, a restaurant that can survive this, at some point is going to see their own V-shaped recovery. But they're going to have to get through the winter. I really think there's a lot of pent-up demand for that.
And we've been talking a lot within economic development, saying, winter is coming. And so what are some of the things that our businesses can do just to hold out? Because I think at this point, and we even looked at it as, okay, we'll wait till June. By the time June rolls around, we'll be back to normal. Then it became September, and now we feel like it's a longer term. So what do you do within that time frame to make sure, because there is a light at the end of the tunnel now, it feels like, but we just need to get through some of these cold winter months so that the back end, you're there to anticipate the demand?
Look, some of this becomes esoteric and theoretical because let's face it, as a business, if your bank doesn't work with you, you will not survive, right? If the bank says, I'm pulling your line of credit, that's it.
Yeah.
So we can talk all day long about surviving and cash management and so on and so forth. But the key relationship during times like this, obviously customer relationships are very important. Employer-employee relationships are always very important. But one of the key relationships during periods like this is the relationship with the bank, and for others with the insurance company. Because if you're a construction firm, you can't operate without the right sets of insurance policies, right? The bonding and all those kinds of things.
That's right.
So as I said to people, in 2018, 2019, I said, look, I think we're going to have a recession for the next 12 to 18 months. I didn't know anything about COVID-19, And if I did, you should look at me suspiciously. But I thought that there were enough vulnerabilities that had built up in the economy that we could have an event. And I said, look, make sure you more aggressively preserve cash and talk to your banker and talk to your insurance broker. Firm up those relationships. And one of the things you should do is increase your line of credit, your available line of credit, because that cash can come in handy. I know a lot of us small business owners love having a small line of credit. We take it as a badge of honor. We don't need it. We got a zero balance. What do I need a line of credit for? Boy, during times like this, it really comes in handy, doesn't it? Even if you don't tap into it. So anyway, that opportunity is behind us. Now we're in a period of economic stress. That said, understand from your banker what you need to do to make sure that they continue to give you their support. And what would cost you their support? What would cause that line of credit to be pulled, whatever it happens to be? What are the rules of engagement? I think that's very important in this effort to preserve business enterprises so we can get to the real V shape. Because the real V-shape recovery comes when we don't have to talk about COVID-19 anymore.
It's on to full recovery.
Oh, it's going to be a beautiful thing, right?
Yes. And so, Alex, I look at you. Do we have any questions out there in our audience for today?
Yeah, we have a few actually. Nick, I saw you had your hand up for or so, and then you wrote your question in, so I'll go ahead and just read that here. Thank you for the great info, he says. My question is, what other shocks besides lack of government stimulus do you see that can cause an economic contraction in the near term?
Oh, a contested election. Right, we're looking at November 3rd. We've got mail-in ballots. We've got the possibility that Joe Biden is leading as of November 3rd.
Russian interference.
Trump is right. Russian interference or Chinese interference. And Donald Trump is winning on November 3rd, but then the mail-in ballots get counted. All of a sudden, it's Joe Biden. And my guess is Donald Trump will not respond well to that. That's my guess. And it'll be more than tweets. You know, I mean, tweets will be the least of our problems at that point. So that kind of contested election, so therefore, what happens then? Policymaking is stuck. So if all of a sudden state governments are shutting down their economies, let's say Vermont, Massachusetts, Washington State, as winter starts to impact them more fully, and you need a stimulus, but Congress is stuck because they're focused on this contested presidential election. The next few months are going to be we're 47 days away from an election. This is not a long time away. Are going to be a very uncertain period. Now, again, if Congress passes a stimulus package of some scale, we can take a deep breath and say, okay, that stimulus will keep this economy going until we get to vaccine and through the election, even if it's contested. But that's what I'm worried about. And finally, I haven't mentioned the words trade wars very much. I mentioned a couple of times, but the global supply chain is buckling. Each nation is going in its own direction, right? Sweden is different from Finland, and America is different from Canada, and Brazil is different from everybody. And sort of that confluence of national interests that we saw, or international interests that we saw after World War II, you know, United Nations, general agreement on tariffs and trade, and the World Trade Organization, World Health Organization. A lot of these institutions are falling apart. And so what does it mean for the world, how dangerous it's going to be when nations are going their own direction? So I don't know is the answer, but it doesn't feel good. It doesn't feel safe. And so anyway, those are some of the issues.
Yeah, it's interesting because we built those institutions to, you know, after World War II to protect us and from another world war and kind of glue our economies together. That was the idea at the time, and we're kind of breaking that up.
Now we're fragmenting. That's exactly right. And by the way, there are other so-called black swan threats, right? So in past years, I've talked a lot about black swan, biological contagion being one of them, but there's electromagnetic pulse. There's which would happen because of a dirty bomb. There is cybersecurity attacks on major U.S. financial institutions, which could throw things into disarray, which I always thought was the most probable source of a black swan event, was, you know, that kind of cyber assault on a major financial institution or the federal government itself. So and it's very difficult to protect from the inside threat, right? A lot of these systems are built to protect against the outside invader, but what about the disgruntled COO? You know, so in any case, lots of risks out there.
Yeah. One of our questions, and I think a lot of my colleagues on the call had this similar thought as well as I did, is a question from our director here at Economic Development, Kelly Tucker. Since the largest age group in America are the 28, 29, and 27, I'm kind of fall into that group, and getting to the age where they are more likely to be purchasing homes in suburban communities, and the compounding COVID crisis encouraging distancing, do you think major metropolitan areas like the DMV are in trouble? And what policy action should we be thinking about and considering as a community to kind of address some of
That's
these
a
issues?
great question.
That is a great question, especially in the context of remote work. So if I can do a great, I can have a great job with Amazon wherever I am. I don't have to be in Washington, D.C. necessarily. Though it's interesting because Amazon is still building out its campus as if it's not going to have people work remotely. So that's to be viewed as a very positive sign for people on this call, that there is still commercial real estate, that people are still going to show up to work, and so on and so forth, and all the economic activity that comes out of that. That's a very good question. I am seeing some movement away from very large metropolitan areas to smaller metropolitan areas. So, places like Cedar Rapids, Iowa, are becoming increasingly a destination for remote workers. And we see that, a lot of scenic places around the country are seeing a lot of population growth because people are saying, look, I can live anywhere. I want to live in the prettiest place I can find.
Right? So I don't blame them.
Yeah, so advantage Roanoke, Virginia, advantage, Charlottesville, so on and so forth. That said, humans are humans. Humans crave company. One of the leading sources of depression in our country is the inability to work. So losing a job causes often depression. And the reason for that is not just loss of income, but it's loss of that camaraderie that you get from being with other people. The other thing about it is you might be able to do your job remotely, but can you learn from the best remotely? So one of the things that happens is we learn how to do our jobs better by watching the best in our profession, right? By hanging out with other economists, I get better. Now, I can do some of that remotely, but it's not the same thing as that fireside chat with that very senior economist who can really talk about, the challenges of data analysis or trying to work with an agency to try to figure out what's going on, in housing or whatever it happens to be. So, long story short, I don't think Washington metropolitan area is in deep trouble, but I do see that the next decade will be better, relatively speaking, for smaller metropolitan areas than the previous decade, where much of the economic growth was in the 10 largest metropolitan areas. It was New York, Boston, Washington, and then towns like Austin, Nashville, so on and so forth. That's where the juice was, by and large, in the economy. Other places just missed out on it for the most part. I think that growth will be more democratic this decade.
Interesting, because it was very concentrated on the coast.
Oh, booms. I mean, look, Nashville has a new skyline. So does Austin, Texas. Atlanta, Georgia boomed. San Jose, California boomed. Seattle boomed. But you didn't say the same thing in rural America. Rural America was really stagnant for much of the decade, and many small towns fell behind. And actually, by the way, that's one of the reasons that Donald Trump won in 2016. He won small towns across this country in Pennsylvania, Wisconsin, Michigan, Ohio, so on and so forth, because of that angst. But this decade, I think, because of remote work, because people want to own more square footage, because people are seeking maybe a somewhat lower cost of living, you'll see more democracy and growth. In that large metropolitan areas will continue to boom. I think Atlanta will have a fine decade. It's Atlanta. But you'll see smaller communities, smaller metropolitan areas also thrive.
Should we be concerned, because I always look at New York as a kind of a litmus test on the, in the Atlantic, off the Atlantic. And they seem to be really struggling because they had such a severe shutdown. Now, they say because they saved 70% of people from contracting COVID because of the shutdown that they did. But now I feel like they're feeling it in their economy. Should we be concerned of that at all as we move through this, some of our larger cities?
Maybe a little bit. I'll tell you. So one of the things we've seen in New York, obviously we've seen a lot of out-migration from the city. But a lot of that out-migration has been from Manhattan. And the reason is because Manhattan is terribly expensive. So you've had a shock to the economy. People are no longer willing to pay really high rents. People want a social distance. They want an ownership opportunity to take advantage of lower interest rates. And they want an extra bedroom to turn in to that home office.
To an office,
It's not that they're necessarily running away from the cities. That's sort of the narrative. Is they're fleeing the cities. I don't think that's it. I think what they're looking for is a different type of real estate and a different type of value proposition. And they want to be owners, not renters. A lot of the opportunities to own are in the suburbs. And they want to own somewhat more square footage. Well, a lot of that is in the suburbs. And they also want more space between residences. Well, a lot of that's in the suburbs. It's not that they're throwing a stiff arm to the cities is that the suburbs offer things that they want right now. And then you layer demographics on top of that, and that's what you're going to get. But New York is much more expensive than Washington, D.C. Oh, I know Washington, D.C. is very expensive, don't get me wrong. But Manhattan is off the charts. San Jose and San Francisco are off the charts. And so that's where we see the biggest rent declines.
Kind of like restriction.
Yeah, if you look at the condominium market in Washington, D.C., the District of Columbia condominium market is actually quite strong. Why would the condominium market be strong if people are trying to escape the cities? No, they're looking for a different value proposition, and they're often finding that value proposition in the suburbs.
That makes sense.
That's interesting. Okay. One of our final questions was from Mitten, and he asked, how quickly after a vaccine do you think that a vaccine is available and deployed, do you think unemployment will return to kind of this pre-COVID norms? We talk a lot about, we've heard a lot in the news about getting back to, January 2020, what that would look like. What are your thoughts?
Look, let me ask you this question, Alex. How long did it take us to get to a 50-year low in unemployment?
A decade, almost a decade, right?
No, it took us 50 years. It took us 50 years to get to a 50-year low in unemployment, right? Right, Alex?
Yeah.
Right.
Gosh.
So, so there's no guarantee that we get back to January 2020 immediately, right? 3.5% is unusually low unemployment nationally. And in the Washington metropolitan area was actually lower than that pre-crisis. And so we might not get there for many, many years to come is what I'm trying to say. But if you ask me the question, how fast will it take for us to get to sustain less than 5% unemployment, which often economists determine to be roughly full employment, 3 years, 4 years, something like that? Because here's what's happened. The molecular structure of the economy has been shattered, right? We had all these coherent small businesses blown up. We had all this commercial real estate that was occupied, office buildings, retail space, space for restaurants, emptied. And so there is some vulnerability there in the economy. We have a massive national debt. We have the possibility of tax increases, right? We have the possibility that we're going to see more regulations come back, right? The pendulum tends to swing in policy. I'm not saying that's good or bad. It's just how we go from deregulation to re-regulation to deregulation. Well, we just went through a period of deregulation. So guess what's next? So I think it's going to take quite some time to get back to where we were. The good news is we have shown with this initial phase of economic expansion how quickly the American economy can get back to some semblance of normalcy. But to get back to that phenomenal 50-year low in unemployment, that's going to take some time. It could take 50 years.
Wow.
Okay, yeah, that's a fair point. That's a fair point. I guess, we got time. Do we got time for one more? Looks like 2 minutes.
Yeah, we got time for one.
One of our attendees was asking about, on the slide about that you showed, they asked, what was the reason for the education taking a hit during this crisis, or rather, what area has education been most vulnerable with regards to the COVID situation?
Right. So both education and health services, which tend to be bulwarks of stability during times of economic stress, were hit hard. Again, we talked about elective surgeries and what happened on the healthcare side. Think about educational services, right? What about private educational services? How many kids are now going to continue on in private education? How many people say, well, I'm willing to pay $25,000 or $30,000 a year in tuition or more for remote education? A lot of people are saying, I'm putting my kids back in public school or whatever it happens to be.
Yeah.
So daycare centers often show up in that education category. Daycare centers were walloped during this period, right? So that's why you see what you see. And then I think that some private colleges were in trouble before this for all kinds of reasons. They're going to be even in more trouble going forward, right? Because, all kinds of factors. But again, another shock, which causes people to not want to necessarily pay really high tuition for schools that don't have huge reputational footprints. I'm not talking about Princeton. Princeton's going to be fine. I think Georgetown's going to make it too, which is my alma mater. But there are some schools that are more regional, but they still charge $60,000 or $70,000 a year in tuition plus room and board. I think there are some failures there. So that's the answer to that question.
Gotcha. Okay. Well, very good. Well, I want to be conscious of your time, and Tara, I'll let you close it out.
Yes, well, thank you, Anivan Basu. This was, I think I'm going to be thinking for the rest of tonight into tomorrow, probably for the next week. The information was just spot on and what we need. I think for me, the big plan and what we do within economic development is to try to get much of the facts and much of the information as possible so that as we're making decisions, as we're working with the business community, that we understand fully the deck of cards that we've been given and how to play our hand. I mean, that is to me, your presentation has really kind of summed up in a great way what we all need to be doing as a community, as a business community, and still cultivating an ecosystem where people can succeed. And it sounds to me at the end of the day that it's all there within, there's so many factors, but there is still opportunity available. And so we thank you on behalf of Arlington Economic Development, my hometown of Baltimore, which I adore so much, and I'm so glad you're from there. And so we close out this afternoon. We will be moving forward next Thursday at 10 a.m. We'll be talking about demystifying the current target markets that are available out there for small businesses. So thank you so much again, Anivan Basu, and we will see you all very soon. Thank you.